Major funding for this program is made possible by grants from Bank of America, Merrill Lynch, and Perfect Building Maintenance, Kilroy Architectural Windows, Inc., New York's Window Company, New York Community Bank, Capital One Bank, Greenberg Traurig, LLP. Additional funding is provided by grants from Akron Gold Brothers, LLC, Briarwood Organization, Beechwood Organization, C.B. Richard Ellis, Cushman and Wakefield, Dime Savings Bank of Williamsburg, Hal Fettner, Durst Fettner Residential, First American Title Insurance Company of New York, Friedman, LLP, Gemini Real Estate Advisors, LLC, Jack Jaffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Massey Knackle Realty Services, Meridian Capital Group, M&T Bank, Muss Development, LLC, Des Moines Group, Newmark Knight Frank, Orphanides and Associates, SJP Properties, Sterling and Sterling, Stonehenge Partners, Urban American, W Financial Mortgage Fund, the Witkoff Group.
Hello, my name is Michael Stoller. Last week, we started our discussion on there is money for commercial real estate. So today we're going to continue that discussion with this distinguished group of gurus, lenders, guys who are really lending money. I can't believe it. Today, my guests include Vincent Palagano, the chairman and the CEO of the Dime Savings Bank of Williamsburg, Rick Lyon, the executive vice president of Capital One Bank, John T. Adams, the first senior vice president of mortgage originations at New York Community Bank, Michael Sarkozy, managing director of J.P. Morgan, Dominic Kama, the executive vice president and CEO of Investor Savings, and last but never least, Gino Martocci, the senior vice president in charge of lending in New York and Long Island for M&T Bank. So we spoke about product and other things, but we didn't really get to a discussion that, I was talking about a loan last week in Dallas, in Houston, where it was for $15. In the month of January, an office building in Lower Manhattan is sold for $97 a square foot. For New York Plaza, a building which was built in 1968, originally Morgan, Manufacturers Hanover Trust building over there, was sold for $97 a square foot. How do you look at a deal like that? I mean, the replacement cost, the land, the construction. I couldn't even go to Home Depot and start building this over there. How do you look at a price like that?
What was the cash flow?
The cash flow,
it was empty.
The building,
No.
the cash flow was one tenant, being J.P. Morgan, agreeing to lease back 75% of the space for $28 a foot. But aren't the bricks worth more? I mean, you can't build multifamily for $97 a square foot. This is a concrete building. This is a building on the seaport in New York Plaza. What has happened to values? And how do you look at that when you hear a $97 when perhaps there were loans, there were buildings? And I use this as an example in an article. The article was It's a Bad Dream. In 2006 and 2007, buildings at 14 Wall, buildings at 26 Broadway sold for $375 a foot. $97 a foot. How do you look at something like that? And how do you make a loan? Or do you make a loan? I heard a French bank took the loan. I assume that you saw it. Everyone else saw it.
And again, you got to look at it and say any particular transaction can have an anomaly or whatever. And when dollar per square foot is certainly a measuring stick. We're underwriting today predominantly to debt yields. So we're looking at cash flow. We've always been a cash flow lender. We're looking at debt yields, and we're saying that we think, given the tenancy, this debt yield works, and we're doing that loan. So our yields change, whether it's a single tenant government building or it's a multi-tenanted situation with lease rollover or whatever. So I think you really have to look at a lot of factors today. Replacement cost used to be is one factor, but certain situations you're at the bottom of the market right now.
How much has value dropped when you're lending and the regulators are looking? I mean, appraisers are scared to put numbers because there's difficult comps. 2009 investment sales were down 88% from 2008, 93% from 2007. In New York City, investment sales were $3.5 billion. I mean, that was the entire investment sales, and without assumable debt, it probably would have been one half of that type of number. How do you look at something? And I mean, we've all looked at, we know that the bricks are worth something. How do you look at something?
It's very asset specific and product specific. If you look at a rent stabilized 10-story elevator building on the Upper West Side, you haven't seen that much of a decline in value at all. There's still a lot of bidders on that. Cap rates have climbed a little on that stuff, but frankly, yields are so low that it sort of it's kept that down.
But what about an office building? I mean, let's look at this. A couple of years ago, 450 Park Avenue sold for $1,560 a square foot. Today, there is a sale taking place for 49% of 299 Park Avenue. But the 49% is also with assumable financing. With the UBS. So how do you look at these situations? I mean, when you have a construction loan, I mean, and that's another question. Who's lending on construction today? Are you lending? Are you lending? Are you lending?
Yeah, we're doing some lending in construction loans, but again, it gets back to, who the operator is, what type of equity does he have in the project, and what is the potential use for the project, and how can we expect the project to perform in that particular market?
And I also think we too are considering some construction, primarily if it's a repeat relationship, but pretty much we did pull back totally. But the new buzzword is global cash flows.
Explain to my viewers, what do you mean by global cash flow?
Pretty much you want to look at the staying power of not only the entity, but of the individual behind the entity. Especially with a construction loan, you're going to get, more than likely, you're going to get a guarantee of some sort, whether it be full repayment, completion, limited, whatever. You want to see that all the other assets that they have net of their debt, they have positive cash flow. Because in the event that the interest reserve that you build into your construction loan burns off, dries out because you use it, which in this past 2 years, that's what happened. Regulators frown upon you if there's equity in the property, refinancing that loan and pulling additional cash out to help service your debt. That's a no-no. That's a no-no. So now, and I can't say it's a bad thing that the regulators and your external accountants have put upon you, is to get the global cash flow from the individual who is signing on the dotted line to make certain that when that interest reserve does burn off, does he have the capability and the wherewithal to service the debt beyond what you lent him?
This relates in a different manner to what's happening in the office market in New York, because a lot of people there were a lot of leases signed in November and December of 2009. People would be surprised by the magnitude of the leases signed. But those leases were signed by financial service companies and law firms. They represented over 50%. And more important, they were signed with landlords who were established or were REITs or with people where they knew that the building was going to continue to be owned. They don't want to have a situation where they were afraid the lights were going to go out or there was going to be a situation like that. So I think that's a very important scenario. And we've seen in our own shop, some people come to us and they say, they don't have money. They're using the good building to pay for the bad building. The Peter to Paul philosophy on that situation. So I think that's it. one thing that Gino has done over the years, and you were saying prior to the show, is that you have exposure in hotels. And 2010, I think the hotel, they say the worst market hit first is hotels, and the market to recover is hotels. And hotels occupancy is up as compared to last year.
Since September,
Since
things have really made a drastic
average
change.
daily rate is up. And the good thing is that some of the planned hotels that were planned are no longer planned. I mean, all of the 5-star luxury planned hotels are not taking place in New York. So if somebody came to you today for two types, a construction loan on a hotel or an acquisition of an established hotel, would you look at it? Anyone want to?
Yes, with strong sponsorship, with people we have experience with appropriate leverage. We've always looked at global cash flows and always look at the sort of the health of our sponsorship. And for the right people, absolutely.
Yeah, we haven't. We probably would not look at a construction loan for a hotel, but we do have a number of hotels in the portfolio in New Jersey.
Now, the hotels in New Jersey, are they branded? I mean, do they?
Yeah, they're primarily the Holiday Inn Expresses, the Hilton Garden Inns, those names.
Where you can have a national franchise system.
Non-luxury, I think, is important too.
I think
I think one thing you keep on coming back to is cash flow. The importance is all cash flow. It almost doesn't matter if it's new construction, existing construction, whatever the type of housing. Cash flow is the most important thing that you have to value a piece of property.
Cash flow is important, but what happens, because there is unemployment. Unemployment in New York is still over 12%. And when people lose jobs, they can't pay. Even people in rent affordable apartments, in rent regulated apartments, somebody will look out.
But if you lose 5%, 10% of the tenant's ability that are paying, you provide for that already in your initial appraisal. You're taking a 5% or a 7% vacancy rate. So that's almost anticipated. It should be anticipated anyway by careful underwriting.
Now you've been in Williamsburg for a couple years. We won't tell my audience. You've seen the change in Williamsburg, and I think some of the people over here have made loans. Williamsburg was the go-to spot. Everybody, at one time, the only people knew about Williamsburg is if you went to Peter Luger. Or Belmonte's, they went over to the Situation. But today, what do you see in Williamsburg, and what's happening there? And as a lender, what's people's view of Williamsburg?
Williamsburg is probably booming, or it's reached a point now where it's stalled in its boom. I think there are probably 50-something construction programs now in Williamsburg that have stopped completely. But what they're doing, even with the ones that have been completed, is they're turning around, converting from their original condo ideas and doing rentals. And they're able to rent up. The Williamsburg, Greenpoint market has gotten very gentrified. I think what you've seen is a migration from the city, where you had people in the village before, they moved into Alphabet City, and now those young people again are into the Williamsburg, Greenpoint area. And you can go along some of the streets in Greenpoint area and Williamsburg, and the streets are crowded at night. So the kids are out there, the restaurants are going, the bars are filled. And I think there's been a renaissance in there. 40 years ago, it was nothing like this. You couldn't walk
40 years ago, the
40
needles
years
were
ago.
on the street.
Yeah.
But you're a conduit lender. Would you? And you said you did retail. Would you do retail in Williamsburg today, or is it not enough cash flow, not enough years of experience in that market?
We would look at the rent roll, take a look at the occupancy of that strip of retail, and if there were long-term leases and it was an established retail area, sure.
Now, what about, we're going to go to another neighborhood. You were saying people, Alphabet City. At one time, the dividing line in New York City, I still remember, 79th Street one time, then 86th Street, then 96th Street. Then it went up to 179th Street.
30s to the 80s.
And there were so many developments and projects in Harlem. Everybody was building in Harlem, and unfortunately, a number of those projects are in difficulties. What's your thoughts about today if somebody came to you about a new deal in Harlem?
Stabilized or under construction?
New. I'm talking new. I mean, because ironically, you have limited office buildings in Harlem. The two office towers are still getting $40 or $45 a square foot in rent because they have a limited the government is the government. They're paying the rent. It's like Washington, D.C. But the retail in Harlem on 125th Street is not doing it. It's doing well, but it's not doing as well as it used to be. The apartments in Harlem, the rent is down. But I mean, you all have some exposure.
Yeah, I know. For instance, we have a couple of new construction. We did the construction loans, converting to perms, 3rd Avenue and 100, and it's East Harlem, 101st. They rented up. They got decent market rents, and to a diversified tenancy. It wasn't any one particular.
No. There was an article in the Times. Harlem is totally gentrified.
Yeah.
I mean,
there's a larger percentage of whites.
There's a larger. That's exactly. But what I'm saying is, there were certain markets that people would run into. I mean, it was Lower Manhattan. It was Harlem. It was and that brings up my next question: Park Slope and downtown Brooklyn. I mean, I had never seen so many cranes, and not cranes for 6-story buildings, cranes for 52-story buildings. The Forte, the Brooklyner, the V3 Hotel, all of the situation. I mean, what's anything? I mean, not too far from Williamsburg, Benny. Any thoughts about?
Well, we're doing some lending along 4th Avenue, and I'm not sure you can call that.
Sunset
Slope.
Park?
I call it Sunset Slope.
No, we call that Sunset Park, but the developer calls it Park Slope.
But that's funny when it comes to committee and one of the lenders will say Park Slope. I'll say, well, you need to think twice about that. But yeah, Sunset Park. I mean, if you look at what's happening along 4th Avenue, all the way out to Atlantic Avenue, given Ratner's dream of putting the arena there. Those buildings are going up. I grew up in that area, and to see a hotel on Union Street in Brooklyn is just an amazing sight to me.
And it's a branded hotel.
And it's a branded hotel. The demand is there. A lot of young people. It's along the train line.
Right.
The R
I think
line.
that's the main attraction.
The
it's
R
along the
line.
4th Avenue train line. It's
the
very
R line
convenient.
runs right into Lower Manhattan.
I think the challenge, though, is that these are new buildings. They are leasing up at about what they were hoping to get, maybe 5-10% less. It's can they stabilize? Can they keep that rent level? There's only, right now in this economy, we don't know. There's only one way those rents may go, and it's down.
You bring out an interesting point, because that's what's happened in downtown. I don't know about Park Slope. I do know about downtown Brooklyn because of the magnitude. There are 2,750 apartments coming in downtown, and Avalon Bay is giving away 3 to 4 months free rent, the gym, the other things. So when you take that into consideration, your $35 rent is $22 a square foot, and that's nice. It's like the teaser. You get the teaser, you get them in, sell them the car, and will they be there in a year?
It's hard to say on any of these things. I honestly don't think we need to build much of anything for the next year or two. We still got a lot of inventory to walk to get through and absorb. We're not seeing too many people bring us deals because the amount of equity they'd have to put in to make the deal work from our standpoint, because we take the rents and we'd say, geez, here are all the market comps, 3 months free rent, we're going to underwrite to that. It just doesn't make a whole lot of sense. So we're all working with our clients to help them get the projects they have to stabilization and through the pipe on that. So we're really just not seeing many. We're seeing build-to-suits. So I've got a couple of construction loans that are build-to-suit. I've got a couple of tremendous properties that are where the dirt was so cheap for the guys owned it forever, and now with construction costs down, it makes sense to do something. But those are unique cases. I don't know. Have any of you seen too many really great construction loans where a good sponsor is bringing it to you?
There's nobody in the last year was willing to really commit to to building at this point. There's not a tremendous supply of office, though. There's not a tremendous supply of new rental. There is probably an oversupply of condominiums, but frankly, over the last 6 months, I was shocked by the level of absorption of condominiums. Reasonably well located condominiums over the last 6 months is certainly better than we would have expected in March.
With regard to that, there have been a lot of condominiums in New Jersey. As some people once in a while say, is Jersey City the 6th borough? There have been a lot, and how's the Jersey City, Hoboken condominium and rental market doing? Anyway.
It is doing relatively well. I mean, we, initially, you talked a little bit about the incentives to build in Hudson County, Jersey City, Hoboken. When you compare, $600 to $800 a square foot versus coming over to Manhattan at $1,200 to $1,600 a square foot, and it's a short path train away. I mean, there's still some success, I think, in Hudson County.
What about Newark? I mean, you have Cory Booker over there. The office market is still blah. I mean, nothing's really happened over there. Do you think you can do a conduit loan in an office building or anything in Newark?
If it's leased to a tenant for a long
Well, what is this? Are you, if it fits in the...
Well, we're a cash flow lender, and we look at a rent roll, we look at a lease expiration schedule. And so we're a stabilized rent roll focused
Next
group.
week, I'm having a show with international lenders. And if I said to them, and I'm going to ask them the question, would you do a loan in Newark? I think I will have a unanimous comment, no.
It's not just Newark. You can go through almost any tertiary city, and right now the European lenders aren't going to do it. Touch it.
Right. It could be leased to a life insurance company. It could be leased to the state. It could be leased to a utility company on a long-term basis. So
But what's happened in Newark? I mean, they got a great new arena. I mean, I've been out to the arena. It's great. But the residential hasn't really woken up. The condo market never went into Newark. The office market is still a very cheap opportunity if you want to go, and has great trains. I mean, there's no question about.
I think you hit it on the head, though. I think when the residential, if and when that comes to where it should be in order to revive the rest of the area, nothing's going to happen by way of office or retail. You have the sports arena. That's great. It does bring in a draw, but that's for one event at a time.
Yeah.
Until you see the residential pop or change, in my opinion, not going to see much of a difference.
You still have a lot of crime, drugs, abandoned properties. It's tough to turn that around. And they haven't been too successful in it being able to do so.
Yeah. Here's a question, because I would be, all my audience would be upset because they'd be watching this show, every mortgage broker, if I had to take a loan from you, and I'm going to go around the room, what type of rates, give me a typical loan that you would do today and a rate.
Typical loan for us would probably be in the Brooklyn, Queens area. Rents regulated, the majority stabilized in the building. We'd probably go for a term of 5 years. We will go to a maximum of 75% loan to value, but more typically lately it's probably been 50 to 60% loan to value. Debt service coverage is probably approaching two times, and
Pricing.
very stable. 5.5, 5.8, somewhere in that area for a 5-year term.
Rick?
Yeah, and we try to tailor a loan to your needs, and so forth. We'd look at the cash flows and do that.
Did they get a Capital One credit card with it?
We can give you a loan on a Capital One credit card. We would probably look in again a 3 to 7 year time range, and probably 350 over, and we'd swap that to a fixed rate, which would probably be about 5.5, 6.5, somewhere in that neighborhood.
So you're a little more expensive, perhaps. Mr. Adams.
And again, our multifamily is our main claim to fame. 75% on a rent-regulated building, mid-5s, 5 years, maybe a little bit more for 7. Coverage, though, on a rent-regulated building, we're still comfortable at a 120. But I mean, you got to be truly a rent-regulated building where there is still potential upside. If I went to a commercial property,
It's
probably
a little
closer
hard.
to 65%. 130 to 140 coverage.
Mr. Conduit?
Commercial loans, so it would be an office building, a industrial building, a retail property. We'd be in the mid-6s probably, 10-year term, 30-year AM.
I'm going to go to these guys. They're cheaper.
Well, they're multifamily lenders mostly. It's hard to compete in multifamily, but in the world where we are, our competition would be a life company, and we're in the same zone as a life company. Debt yield of 12, term of 10 years, 30-year amortization.
Tom?
if you look at the array of products that we have, we'll probably, in the multifamily world, go from, and again, talking about A credits now, okay, probably talking somewhere in the area of 5.5 to 5 5/8, and then as we go through commercial, retail, C&I, industrial and development, probably in the 6.25 to 6.5% range.
Gino?
Yeah, I mean, it varies by product, as we pointed out earlier. So 60 to 75% LTVs, rates from sort of 5 5/8 to, for hotels, whatever we can get.
Hotels or
We
construction?
can get pretty much what we want. Yeah.
I mean, it's an interesting thing. This is really more geared to you because you're Jersey. The industrial is a big Jersey product. Have you lent on the industrial marketplace in New Jersey?
We have,
The warehouses?
we have done some lending there. Again, those are, look at the sponsor, look who's in there. The conduits, want to do the loans, but just need the capital and have to let the loans go. So in many cases, we're picking up, good quality loans, and taking advantage of what's happening in the conduit market.
So looking at it, if I had to, conclude, I'd say all of you are cautiously optimistic for 2010. All of you will continue to lend, and probably in certain questions, and I didn't bring it up, many of you will participate because at one time you can't do those big loans together. I mean, you can do loans from 10 million to 100 million, you said, or $200 million over there. But on the average, there's a certain comfort level. You said about 5 million is your comfort level. You'd like 10 to 25 million. John?
A comfort level, 5 to 10, but we'll do upwards of 50, 60.
Yeah, and
Comfort level like John, 5 to 10, but we'll do deals up to 25.
And the guys from New Jersey, since you're in New Jersey, you're going to be doing more business in New York?
Yeah, we are. We're looking at New York as a way to expand our multifamily business because, 70% of the people in New York City live in apartment buildings.
So I'd like to thank you for your participation in the past 2 weeks. I think my audience and I got a pretty good idea of who has the money and who's going to lend the money and who's been lending the money for many years. I'd like to thank Vincent. Palagiano. I will resolve this before. My friend Vincent, the chairman and CEO of the Dime Savings Bank of Williamsburg. Rick Lyon, executive vice president of Capital One Bank. John T. Adams, first senior vice president of mortgage originations at New York Community Bank. Michael Sarkozy, managing director at J.P. Morgan Chase. Dominic Kama, executive vice president and CEO of Investor Savings Bank, and Gino Martocci, senior vice president and head of all lending in New York and Long Island for M&T Bank. Next week, we will talk to the international lenders and see where their money is. See you next week.
Major funding for this program is made possible by grants from Bank of America, Merrill Lynch, and Perfect Building Maintenance, Kilroy Architectural Windows, Inc., New York's Window Company, New York Community Bank, Capital One Bank, Greenberg Traurig, LLP. Additional funding is provided by grants from Akron Gold Brothers, LLC, Briarwood Organization, Beechwood Organization, C.B. Richard Ellis, Cushman & Wakefield, Dime Savings Bank of Williamsburg, Hal Fettner, Durst Fettner Residential, First American Title Insurance Company of New York, Friedman, LLP, Gemini Real Estate Advisors, LLC, Jack Jaffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Massey Knackle Realty Services, Meridian Capital Group, M&T Bank, Muss Development, LLC, Des Moines Group, Newmark Knight Frank, Orphanides and Associates, SJP Properties, Sterling and Sterling, Stonehenge Partners, Urban American, W Financial Mortgage Fund, the Wickoff Group.